Question 1. An insured purchases a life insurance policy and names his wife as the primary beneficiary and his son as the contingent beneficiary. If the insured and his wife are killed in a common accident and it cannot be determined who died first, which of the following typically applies? A. The death benefit will be paid to the insured's estate. B. The death benefit will be paid to the contingent beneficiary, the son. C. The death benefit will be split equally between the wife's estate and the son. D. The death benefit will be paid to the primary beneficiary's estate. Answer: B. The death benefit will be paid to the contingent beneficiary, the son. In situations where it's unclear who died first in a common accident, the Uniform Simultaneous Death Act is usually applied, which presumes the primary beneficiary died before the insured. This ensures the death benefit proceeds are paid to the contingent beneficiary, if one is named, preventing the funds from being tied up in the primary beneficiary's estate. For example, if a husband and wife die in a car crash and the wife is the primary beneficiary, the law presumes she died first, so the benefit goes to the next designated person. Always ensure your beneficiaries are clearly designated and reviewed regularly. Question 2. All of the following are characteristics of an adjustable life policy, except A. Policyholders can increase or decrease the premium payments. B. Policyholders can increase or decrease the face amount. C. It combines features of both term and whole life insurance. D. It allows the policyholder to self-direct the investment of cash values. Answer: D. It allows the policyholder to self-direct the investment of cash values. An adjustable life policy offers flexibility, allowing policyholders to adjust premiums and face amounts, and it does combine elements of term and whole life insurance by letting the insured change between the two forms of coverage. However, it does not permit the policyholder to self-direct the investment of cash values. That characteristic is typically found in variable life or variable universal life policies, where cash values are invested in separate accounts. Remember, adjustable refers to the ability to change coverage and premiums, not investment control. Question 3. What is the primary purpose of the incontestability clause in a life insurance policy? A. To protect the insurer from fraudulent claims. B. To allow the insurer to contest claims for any reason within the first 2 years. C. To prevent the insurer from denying a claim based on misrepresentations after a certain period. D. To ensure that the policy's cash value is guaranteed. Answer: C. To prevent the insurer from denying a claim based on misrepresentations after a certain period. The incontestability clause states that after a policy has been in force for a specific period, usually 2 years, the insurer cannot deny a claim based on misstatements made in the application, even if they were material. This clause protects the policyholder and beneficiaries from unforeseen challenges to the death benefit many years after the policy was issued. For instance, if an insured mistakenly stated their age incorrectly on the application, after 2 years, the insurer typically cannot contest the claim due to that error. This provision provides security and certainty that the policy will pay out. Question 4. An applicant for a life insurance policy has a hazardous hobby, such as skydiving. What action will the insurer most likely take to cover this additional risk? A. Decline the application. B. Issue the policy with a lower face amount. C. Issue the policy with an exclusion rider. D. Issue the policy with a reduced premium. Answer: C. Issue the policy with an exclusion rider. When an applicant presents an increased risk due to a hazardous hobby, the insurer often issues the policy with an exclusion rider. This rider states that the policy's death benefit will not be paid if the insured's death results directly from participation in that specific hazardous activity, like skydiving. This allows the insurer to cover the applicant for standard risks while excluding the exceptionally high-risk activity, providing coverage where it might otherwise be denied. Always be transparent about all activities on the application to avoid future claim issues. Question 5. All of the following are considered types of ordinary life insurance, except A. Whole life. B. Universal life. C. Term life. D. Group life. Answer: D. Group life. Ordinary life insurance typically refers to individually purchased life insurance policies, which include whole life, universal life, and term life. These policies are purchased by individuals and owned by them, often with unique terms and conditions. Group life insurance, however, is a single policy covering multiple individuals, usually employees of a company or members of an association, and is characterized by a master policy issued to the group sponsor. Think of ordinary as individual, and group as, well, for a group. Question 6. Which rider typically covers the cost of medical care, nursing home care, or home health care for an insured who becomes chronically ill? A. Waiver of premium rider. B. Accidental death benefit rider. C. Long-term care rider. D. Guaranteed insurability rider. Answer: C. Long-term care rider. The long-term care rider allows a portion of the life insurance policy's death benefit to be used to pay for qualified long-term care expenses, such as those incurred in a nursing home or for home health care, if the insured becomes chronically ill. This provides a living benefit, meaning the insured can access funds while still alive to cover significant care costs. Unlike other riders that add benefits at death or waive premiums, this rider specifically addresses the financial burden of extended care. This rider offers a practical way to combine life insurance with future care needs. Question 7. What is the primary characteristic that distinguishes a participating life insurance policy from a non-participating policy? A. Participating policies are always more expensive. B. Participating policies pay dividends to policyholders. C. Non-participating policies guarantee a higher interest rate. D. Non-participating policies have a higher cash value growth. Answer: B. Participating policies pay dividends to policyholders. A participating life insurance policy is one issued by a mutual insurance company, meaning it is owned by its policyholders. These policies are eligible to receive dividends, which represent a share of the company's divisible surplus and are not guaranteed but are often paid out annually. In contrast, non-participating policies are issued by stock insurance companies, owned by shareholders, and do not pay dividends to policyholders. The core difference is the potential for policyholders to receive a portion of the insurer's profits through dividends. Question 8. An insured has a $200,000 convertible term life insurance policy. If the insured wishes to convert this policy to a whole life policy, which of the following is true? A. The conversion must occur at the attained age, requiring a new application and underwriting. B. The conversion can occur without evidence of insurability. C. The premium for the whole life policy will be based on the original issue age of the term policy. D. The cash value from the term policy will transfer to the new whole life policy. Answer: B. The conversion can occur without evidence of insurability. A key feature of a convertible term life insurance policy is the ability to convert it to a permanent policy, such as whole life, without having to prove insurability again. This means that even if the insured's health has declined since the original term policy was issued, they can still obtain permanent coverage. The premium for the new whole life policy will typically be based on the insured's attained age at the time of conversion, reflecting their current age and risk profile. This conversion privilege is a valuable safeguard against future uninsurability. Question 9. An insured's life insurance policy includes a waiver of premium rider. If the insured becomes totally disabled, what is the effect on the policy? A. The policy will lapse immediately. B. The insurer will pay a lump sum to the insured. C. The premiums will be waived, and the policy will remain in force. D. The cash value will be surrendered to pay future premiums. Answer: C. the premiums will be waived, and the policy will remain in force. The waiver of premium rider is designed to protect the policy if the insured becomes totally disabled, as defined in the policy. If this occurs, the insurer will waive future premium payments, keeping the policy in force without any additional cost to the insured during the period of disability. This prevents the policy from lapsing due to the insured's inability to pay premiums during a time of financial hardship caused by disability. It's a crucial rider for maintaining coverage when income might be severely impacted. Question 10. Which life insurance policy allows the policyholder to vary premium payments and face amount, and has cash value growth tied to the performance of a separate account? A. Whole life. B. Universal life. C. Variable whole life. D. Variable universal life. Answer: D. Variable universal life. Variable universal life, VUL, insurance offers the ultimate flexibility, combining features of universal life, adjustable premiums and death benefits, and variable life, cash value invested in separate accounts chosen by the policyholder. The variable aspect signifies that the cash value is tied to market performance, providing potential for higher returns but also greater risk, while universal signifies the premium and death benefit flexibility. This policy type is distinguished by both its investment flexibility and adjustable premium/death benefit features. Question 11. All of the following are common dividend options for a participating life insurance policy, except A. Paid-up additions. B. Cash payment. C. Reduced premium. D. Interest on cash value. Answer: D. Interest on cash value. Common dividend options for participating life insurance policies include taking dividends in cash, using them to reduce future premiums, allowing them to accumulate at interest, or using them to purchase paid-up additions, small single premium policies that add to the death benefit and cash value. Interest on cash value is not a dividend option, rather, cash values generally earn interest as part of the policy's design, independent of dividend payments. Dividends are a return of unused premiums, not interest earned on the policy's internal funds. Question 12. What is the human life value approach primarily used to determine? A. The amount of cash value a policy will accumulate. B. The appropriate amount of life insurance coverage an individual should purchase. C. The premium rate for a specific life insurance policy. D. The insurer's solvency and ability to pay claims. Answer: B. The appropriate amount of life insurance coverage an individual should purchase. The human life value approach calculates the present value of an individual's future net earnings that would be lost to their dependents if they were to die prematurely. This method helps determine how much life insurance coverage is needed to replace that potential income, providing a financial safety net for surviving family members. For example, if someone earns $50,000 annually and has 20 working years left, this approach would factor in taxes and personal expenses to arrive at a projected income replacement need. It focuses on the economic value of an individual's life to their family. Question 13. Which of the following statements regarding the grace period in a life insurance policy is most accurate? A. If an insured dies during the grace period, the policy will lapse, and no death benefit will be paid. B. The grace period is typically 60 days, during which the policy remains in force even if the premium is not paid. C. If an insured dies during the grace period, the death benefit is paid, but any unpaid premium is deducted. D. The grace period applies only to term life policies, not permanent policies. Answer: C. If an insured dies during the grace period, the death benefit is paid, but any unpaid premium is deducted. The grace period, typically 30 or 31 days, depending on the state, is a safety net built into life insurance policies, allowing the policy to remain in force for a short period even if a premium payment is missed. If the insured dies during this period, the death benefit will still be paid to the beneficiaries, but the overdue premium will be subtracted from the payout. This ensures coverage continues for a short time, preventing immediate lapse due to a slight delay in payment. Question 14. What is the primary purpose of the free look period in a life insurance policy? A. To allow the insurer to review the policy terms again. B. To permit the policyholder to return the policy for a full refund if dissatisfied. C. To enable the beneficiary to make changes to the policy. D. To allow the policyholder to increase the face amount without underwriting. Answer: B. To permit the policyholder to return the policy for a full refund if dissatisfied. The free look period, also known as the right to examine period, is a mandatory provision that gives the policyholder a specified number of days, usually 10 or 20, varying by state, to review the policy after delivery. If dissatisfied for any reason, the policyholder can return the policy to the insurer during this period for a full refund of all premiums paid. This ensures consumers have time to review their purchase without financial penalty. Question 15. All of the following are considered types of term life insurance, except A. Level term. B. Decreasing term. C. Increasing term. D. Modified whole life. Answer: D. Modified whole life. Level term, decreasing term, and increasing term are all variations of term life insurance, where the death benefit remains constant, decreases, or increases, respectively, over the policy's term. Modified whole life, however, is a type of permanent life insurance policy where premiums are lower for an initial period, e.g., 5 years, and then increase to a higher level for the remainder of the policy's life. It is not a form of term insurance, as it provides coverage for the insured's entire life. Question 16. What is the purpose of the Medical Information Bureau, MIB? A. To provide insurers with a central database of medical treatments. B. To allow insurers to share medical information about applicants to prevent fraud. C. To conduct medical exams for insurance applicants. D. To regulate the medical underwriting practices of insurance companies. Answer: B. To allow insurers to share medical information about applicants to prevent fraud. The Medical Information Bureau, MIB, is a non-profit organization that maintains a coded database of medical and hazardous avocational information on applicants. Insurers use MIB reports to identify applicants who may have omitted or misrepresented material health information on their applications, helping to prevent fraud and assess risk more accurately. It does not contain full medical records but rather codes indicating impairments or hazardous activities reported by other member insurers. It acts as an alert system for insurers, not a comprehensive medical history provider. Question 17. Which of the following statements regarding the taxation of life insurance death benefits is generally true? A. Death benefits are typically taxable as ordinary income to the beneficiary. B. Death benefits paid in a lump sum are generally received income tax-free by the beneficiary. C. Death benefits are subject to federal income tax if they exceed $1 million. D. Death benefits are considered taxable capital gains. Answer: B. Death benefits paid in a lump sum are generally received income tax-free by the beneficiary. In most cases, the death benefit from a life insurance policy, when paid as a lump sum to the beneficiary, is received free of federal income tax. This is a significant advantage of life insurance, providing a tax-efficient way to transfer wealth to heirs. While there can be exceptions, such as if the policy was transferred for value, the general rule is income tax-free for the beneficiary. This tax advantage makes life insurance an attractive tool for financial planning and wealth transfer. Question 18. An insured takes out a loan against their whole life insurance policy's cash value. If the insured dies before repaying the loan, what happens to the death benefit? A. The death benefit will be forfeited entirely. B. The outstanding loan balance will be deducted from the death benefit paid to the beneficiary. C. The beneficiary will be responsible for repaying the loan. D. The insurer will pursue repayment from the insured's estate. Answer: B. The outstanding loan balance will be deducted from the death benefit paid to the beneficiary. A policy loan taken against the cash value of a whole life policy is essentially borrowing your own money, with the policy serving as collateral. If the insured dies before repaying the loan, the outstanding loan amount, plus any accrued interest, will be subtracted from the total death benefit paid to the designated beneficiary. This ensures the insurer is repaid for the loan while the beneficiary still receives the remaining proceeds. It's a common way to access policy cash value without fully surrendering the policy. Question 19. Which life insurance policy allows the policyholder to choose how the cash value is invested, typically in subaccounts that resemble mutual funds? A. Whole life. B. Universal life. C. Variable life. D. Modified Endowment Contract, MEC. Answer: C. Variable life. Variable life insurance policies are unique because they give the policyholder control over the investment of the cash value, which is placed into separate accounts that are invested in stocks, bonds, or money market instruments, similar to mutual funds. This offers the potential for higher returns but also carries investment risk, as the cash value can fluctuate. Because of the investment risk, variable life policies are considered securities and require a securities license to sell, in addition to a life insurance license. Question 20. What is the primary purpose of the automatic premium loan, APL, provision in a permanent life insurance policy? A. To allow the policyholder to borrow against the cash value for any purpose. B. To prevent the policy from lapsing due to unpaid premiums. C. To automatically increase the death benefit without underwriting. D. To automatically convert term insurance to permanent insurance. Answer: B. To prevent the policy from lapsing due to unpaid premiums. The automatic premium loan, APL, provision is a non-forfeiture option that, if elected, automatically takes a loan from the policy's cash value to pay an overdue premium, thereby preventing the policy from lapsing. This acts as a safety net, ensuring the policy remains in force during temporary financial difficulties, as long as there is sufficient cash value to cover the premium. It's an important feature that helps maintain coverage and avoid accidental policy termination. Question 21. What is the primary characteristic of a modified endowment contract, MEC? A. It is a type of term life insurance policy. B. Its premiums are significantly lower than traditional whole life policies. C. It loses some of the favorable tax treatment of traditional life insurance due to excessive funding. D. Its cash value growth is not taxable under any circumstances. Answer: C. It loses some of the favorable tax treatment of traditional life insurance due to excessive funding. A modified endowment contract, MEC, is a life insurance policy that has been funded too quickly or overfunded, exceeding certain IRS-defined limits, the 7-pay test. While it still provides a tax-free death benefit, MECs lose some of the tax advantages of traditional life insurance, specifically regarding withdrawals and loans from the cash value. These distributions are treated as last money in, first money out, and are subject to income tax and a 10% penalty if taken before age 59 and a half. This designation exists to prevent policies from being used primarily as tax-advantaged investment vehicles rather than for their primary purpose of providing a death benefit. Question 22. An individual wants life insurance coverage for a specific period, after which they anticipate their financial obligations will decrease. Which type of policy would be most suitable? A. Whole life. B. Universal life. C. Term life. D. Variable universal life. Answer: C. Term life. Term life insurance is designed to provide coverage for a specific period or term, such as 10, 20, or 30 years. It is ideal for individuals who need coverage for a finite duration, such as during their child-rearing years or while paying off a mortgage, and expect their need for coverage to diminish afterward. Unlike permanent policies, term life does not build cash value and typically has lower initial premiums, making it a cost-effective solution for temporary protection needs. Question 23. What is the standard policy provision that prevents an insurer from canceling a policy due to misstatements on the application after the policy has been in force for a specific period? A. Entire contract clause. B. Reinstatement provision. C. Incontestability clause. D. Misstatement of age or sex clause. Answer: C. Incontestability clause. The incontestability clause specifies that after a policy has been in force for a certain period, usually 2 years, the insurer cannot void or contest the policy based on misrepresentations or omissions in the original application. This protects the policyholder and beneficiaries by ensuring that, after the initial period, the policy will not be challenged on the grounds of application inaccuracies. It provides stability and certainty regarding the validity of the contract. Question 24. Which of the following statements about policy dividends from a mutual insurer is correct? A. Dividends are guaranteed and taxable income. B. Dividends are a return of unearned premium and are generally not taxable. C. Dividends are taxable capital gains. D. Dividends are only paid if the policyholder chooses the cash option. Answer: B. Dividends are a return of unearned premium and are generally not taxable. Policy dividends, typically paid by mutual insurers, are considered a return of an overcharged premium, not a taxable event. Insurers set premiums conservatively, and if actual mortality and expense experience is more favorable than anticipated, a portion of the surplus may be returned to policyholders as a dividend. Because they are viewed as a return of the policyholder's own money, dividends are generally received income tax-free, unless they exceed the total premiums paid into the policy. Question 25. When a life insurance policy is assigned, what does this typically mean? A. The policy's ownership is transferred to another party. B. The beneficiary designation is changed. C. The cash value is used to pay premiums. D. The policy is converted from term to permanent. Answer: A. The policy's ownership is transferred to another party. An assignment of a life insurance policy means that the policy owner transfers some or all of their policy rights, or even the entire ownership, to another party. This can be a collateral assignment, where the policy is pledged as security for a loan, e.g., to a bank, or an absolute assignment, where full ownership of the policy is permanently transferred to another person or entity. It essentially reassigns the rights and control associated with the policy.